Lesson number 30. And remember, whenever we talk of an auditor, what is the work of an auditor? The tripartite relationship. And how does this relationship come? We have like 1 million of us. We contribute each one of us 1,000 Kenya shillings. So once we do 1,000 Kenya shillings, we shall be able to raise 1 billion Kenya shillings. And then we go and start one new organization called XYZ Limited. It will be very, very hard for these 1 million people to stay in Nairobi headquarters here to run XYZ Limited. It means that for proper management, we need to appoint like 10 people. So these 10 people are the ones we shall be able to call directors of XYZ Limited, and they'll be able to direct activities of XYZ Limited, including accountability. So at the end of the year, they have to produce what we call financial statements, financial reports. Ladies and gentlemen, of course, we are aware that generally human beings are greedy. Greediness is what defines most of us. Is there any individual in this room who is not greedy at all? Any individual in this room who is not greedy at all? Kwamba wewe kuna tumbo white, safi kabisa, hauna roho black, roho chafu. Nani huyo mbaya sio greedy? Now remember, greediness, ladies and gentlemen, is all about admiring. So you have done your hair today as a lady. When you were at the salon, you thought, this is the very best. But the minute you walk outside, you'll be able to see another lady who has better hair than yourself. You start in this case imagining like, next time or even immediately, if I could get ways of making my hair like that girl, I'll be very, very happy. There must be a day when you are earning 20,000 shillings. And in this case, you used to think, this was good money until you realize that your expenses were now at exactly 20,000 or even more. So you sat down, prayed to your Lord. Your Lord had your cries, spoke to your boss doubled to 40. So you thought like, this is it now, I'm a rich person. Ladies and gentlemen, we always admire these things before we get them. Once we get them, they cease to be a motivator. Even if today you were to get somebody to give you a salary of 100,000, you'll only enjoy like 2-3 months. After that, you realize, this is nothing. Our operations, because of the concept that a human being will never be satisfied, they'll only be satisfied once they are dead. Let me know whether you are able to hear Mwalimu, because I can see I have an internet challenge. Are you able to hear me? Are you able to? Great. So in this case here, these human beings can only be satisfied once. In this case here, they are down there, dead, and of course buried. But before then, if you're not careful, we as shareholders who went home, those 10 directors will steal almost everything. And that is what even happens in our national. Yeah, you don't have to see me, because if I put on my camera, then I distort the internet. Now you have to work without Mwalimu's face. Yeah, great. So ladies and gentlemen, that is what happens also in our national governance systems. You appoint your local member of parliament who had like nothing. Some of them we see campaigning using donkeys and bicycles, but once they get to parliament, they become very great thieves and they never get satisfied. Yeah, they keep on stealing, even from a country as poor as Kenya, which has got nothing now to be stolen. They're putting us into problems. So then, ladies and gentlemen, listen, these are 1,900,000 and something shareholders who went back home and appointed 10 directors. They must ensure that the directors who are there don't steal. The directors who are there are able to report the actual occurrences in the company for the whole year correctly. And that is why the shareholders who go home, they must appoint a third eye, an independent eye by the name of an auditor to come and do what here? Audit the operations of those 10 directors or so who are in office. Otherwise, ladies and gentlemen, if we don't keep them under check, they will steal everything. Remember this research that was done just the other day in Kenya here. About 70% of employees go to their workplaces every morning with an intention of stealing. Yeah, even yourself. Right now, you are attending my class here because you are stealing your boss's time, but we shall overcome. That one I forgive you. You are here to get what here? Knowledge. That one I forgive you. All right? So then if we don't put these employees, ladies and gentlemen, under checks, these directors under check, they will steal everything. If it's a railway company, they will steal the railway platform. Yeah, the rails themselves. They will steal even hizo mabogi zote, hautabaki na chochote. So we must check these people. We must put in controls. And on top of putting in controls, the very best check is to bring an external auditor. So then when this external auditor is brought, remember, as I always tell you, if you want to pass this subject round 1, when you have been appointed as an external auditor of XYZ, you must try as much as possible for you to be independent. An auditor is an independent examiner of financial statements prepared by the management or directors or those who are charged with the responsibility of governance. So that at the end of the day, this independent checker, this independent practitioner known as an auditor will be able to give an opinion as to whether those financial statements are true and fair. All right. Now, please listen, ladies and gentlemen, and listen to me very well. When you are hired as an auditor, you must strive. You must always cry to be very, very independent, especially of the directors you have been sent to go and catch. Remember, you have been sent to go and catch, quote unquote, a thief or thieves, those directors. Yeah, like at the national level, we have the office of the Auditor General being sent to catch thieves in Kenya. Those who are charged with the responsibility of managing our country's affairs. Now, how do you ensure that you are independent? By always looking at what we call surface. Always, you look at what we call surface. Surface like this. Let me put my caps on. Surface. Surface like that. So remember the surface model, the S in this case here stands for self-interest. The S stands for self-interest. Self-interest. Yeah, I can see already you have them. Thank you so much. Yeah. So if, for example, you have been sent to catch a thief, and then you have an interest in that company, then automatically you will not be able, you'll just reach there and tell them, I mean, I've even been sent to catch you, but I don't want to do that because, I mean, we are eating together. We are eating together. So this self-interest, normally, how does it arise outside here? Imagine 𝗖𝗕𝗙𝗵𝗃𝗃, if she was to really pray very, very well, and then I'm assuming, and this is a bad example, but just imagining that she gets the CEO, or rather somebody who is going to be the CEO of Safaricom marrying her. Yeah, good prayers. Yeah, and it's a joke, remember. So now, in this case here, Catherine does her CPA very well. She becomes a CPA. She registers an organization of certified public accountants. She does very well. She rises to the level of the big 4. Now she becomes among now the big 5. Her new firm becomes big 5. Catherine and Associates. And then in this case here, Catherine is appointed to go and audit Safaricom, where the husband is the CEO. I mean, Catherine will be having all the interests in the growth of Safaricom. Safaricom is a company that pays the CEO over Kenya shillings 200 million per year. Talk of 15 million per month. If Catherine goes ahead and says, hey, Safaricom, they have been able to doctor their financial statements, of course, the CEO will go home. Who would want a CEO who is earning 15 million a month, and this is your husband, to simply come and start staying at home? In this case, you're just flipping through Netflix channels. You have an interest to protect there. So you must ensure, ladies and gentlemen, that whenever you are appointed here to go and manage, or rather and audit a company, that you are really independent. And to be very, very independent, you must ensure that you don't have any interest in the name of serious or rather senior employees of that company, for example, being your relatives or your close friends. You don't have an interest by, for example, owning shares in the company that you are auditing, significant shares. Yeah, you must strive in this case here to be independent for you to be able to issue an objective opinion, not a biased opinion. Ladies and gentlemen, that is 𝗖𝗕. We have A. A in this case here in 𝗖𝗕 stands for advocacy. You know, an advocate is somebody, for example, will represent you in a court of law. An advocate is a person who champions your interests. So if, for example, it is Aura and the company that has been appointed, and this really has come to our attention so much as auditors. Yeah, like in most cases, you know, most of these big firms, they are litigants. They like going to court. Most of the times, you'll be surprised. They like going to court or even being taken to court. And in most cases, they will come and tell you as an auditor, because you know our numbers, because you know that we have not stolen, so please come and be a witness. Please refuse. Because the moment you go and witness for or even against the company you are auditing, automatically you are attached to that company at the hip. And it's not even about just witnessing in a court of law. It can also be in the form of what here, in the form of just marketing. Like for sure, if you look at right now, the college is doing very well outside here. It's RCM. And one of the reasons why we are doing very, very well is because of the marketing that you guys are doing for us out there on social media. Yeah, so automatically you are really attached to RCM because you've even been our student. So when you finish doing your CPA, for sure, given that you have been speaking so well of us outside there, you should never become our auditor. Audit other colleges outside there because you don't even know their history. You know RCM so much. For example, you could be Dr. Aura's friend here. So when you start auditing us, what you will be biased in your opinion. You are our advocate outside there already. Yeah, we have 𝗖𝗕. So we have F for familiarity. Familiarity, ladies and gentlemen, how does this arise? This arises because of staying. You are overstaying in a company. Once, ladies and gentlemen, you audit us, say, for 10 years or so, we'll get so much used to each other. Over 10 years, of course, not unless you're another one, you must have called me for a cup of coffee outside there. Because, I mean, we keep on seeing each other year in, year out. Yeah, so you must ensure that you are not so much familiar, you don't get so much used to the people that you are auditing. Because as an auditor, you're supposed to be exercising what we call skepticism. Skepticism is whereby you are doubting whatever facts you're being given by the directors, you are always doubting them. You can't be able to doubt them when you have so much been used to them. You've become family. Unajua hata siku hizi huwa nashangaa because of how you guys get used. You know, you'll send some people. Like we are the ones who are auditing one of these biggest hotels in Mombasa, that's 𝗖𝗏𝗏. So I've sent these Gen Zs down there. So when I go down there to close the file as a managing partner or even as an engagement partner to see the work that has been done for reviews, then you realize that these guys are meeting their counterparts in that hotel and they're doing high five when they're walking on the streets. You're an auditor should be able to carry themselves in some way. I'm not saying that you become like an animal. Of course, we are social beings. But the moment you start, in this case here, doing high five, hugging them, I mean, then you are not an auditor. Remember, an auditor is a detective. You are like a DCI. A DCI will, the moment you start familiarity with these people, there is no way you'll be able to investigate them very well. So please keep distance. You should not be the one, now you are coming from Mombasa, or rather from Nairobi to Mombasa, and then you get the finance director of that hotel telling you, in this case here, Abel, let's meet somewhere for, a beer. And then you say, hooray. Then you are not born to be an auditor. An auditor in this case here shall know how to keep some distance because you've gone down there to investigate them. You are a detective. You are a detective. It should be just very cold. Hi, how are you? I want this. I want this. Was this done? Yeah, very, very important. So familiarity. So we have here surface. We have a I. I, in this case here, stands for what here? Intimidation. Intimidation. Remember, intimidation, ladies and gentlemen, comes because of so many reasons. As auditors, I remember when we were auditing some parastatal here in Kenya, yeah, state-owned business unit. I mean, every director would want to know the opinion you're going to give. And most of them in this case, will even call and they send you funny messages that should you, in this case, they call it disqualify. Should you disqualify our financial statements? You know, they don't know the concept of qualifications and qualified report. They talk of disqualify. Should you disqualify our financial statements? I mean, we shall ensure that the nearest distance you will be in Nairobi here is 900 meters. I don't know where 900 meters, kilometers. That they're going to ensure that you get away out of Nairobi. You know, that is undue pressure. Undue pressure, ladies and gentlemen, could also come because of what we call lowballing. 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 And this has happened, yeah, even to us as an audit firm, especially when we were very, very new. Yeah. So you want a job. You badly need this job. This is 𝗖𝗚𝗙𝗃 Bank. You'd want to audit 𝗖𝗚𝗙𝗃 Bank. So you go there. Other auditors are quoting 30 million, 20 million for this kind of behemoth of a company. And there you are as Aura and the core, because you don't even have experience, you quote 2 million. So these guys give you the job because, you know, in these economic times as well, all right, everybody's looking at like, how do I save? So at times in this case, they don't even look at quality so much. So they've given you the job at 2 million Kenya shillings. So 2 million, and some of these organizations may need what we call continuous audits. Yeah, they need what we call continuous audits. So under continuous audits, ladies and gentlemen, under continuous audits, remember, you may be forced to put your team members, audit team members, in some of these branches here for a whole year. Yeah, some of these big organizations that have risky transactions, they may need continuous audits. At the very best, they will need an interim, if you are lucky, an interim, and of course, end of year audit. So you can imagine like using a 𝗖𝗚𝗃 Bank with 2 million Kenya shillings that you have charged, really, will you be able to cover all the branches? You will basically be on your knees because you played low ball. Others were playing high ball for them to score and do good work. You are playing low ball. Atataka kupiga watu chobo. Yeah, chini pale kabisa. Yeah, so you have been able to play this ball down there. Then that means that you'll also be on your knees down there, begging these directors that, you know, even the fees that I'm charging you is not enough. It's not enough. So when you are on your knees down there, it means automatically you must sing to their tunes. If they tell you dance left, we increase your audit fees to 3 million, you dance left. If they tell you to jump, you can only ask them, how high do you want me to jump? You know, that automatically is intimidating, ladies and gentlemen. When you do your quotation as an auditor without knowing the scope of work, some of these organizations, they are spread all over East Africa, all right? Without knowing your scope of work, I can tell you that work which you'll be doing, upon it being spelled onto you, you will really be scared. Remember, intimidation is about you being scared. And when you are scared, I mean, who doesn't like life? Somebody comes and puts a gun, even if it's a fake gun, on your head like this, and then they tell you, hey, give us a good audit opinion, give us a good audit opinion, then automatically, ladies and gentlemen, you will be able to give them that good audit opinion. That is what we call intimidation. And then lastly, we have what we call self-review. We have what we call self-review. How does this self-review come, and how does it make you to be biased as an auditor? Now, assuming, ladies and gentlemen, I'm given non-audit services. So if I'm given non-audit services, I've come to audit, then these guys here see me to be the panacea of all their problems. So then they come and tell me, please do tax computations for us. So now I've been engaged to do tax consultancy for them. So I do the tax computations. I get that the current tax liability is 20 million. So they put this figure in their financial statements. Deferred tax liability is 10 million. They put that figure onto their financial statements. Now, you see, these guys will compile other figures from other sources from their accountants. And then at the end of the day, what will happen, ladies and gentlemen, is that once this report has been finalized, and now it's called an annual report, it will be handed over to the auditor. Once the financial report has been approved and signed by the board of directors, it shall automatically, ladies and gentlemen, be given to the auditor. So when the auditors are looking at sales, they have never seen this figure before. They will be able to do thorough work to check it out. When they look at cost of sales, they have never seen this figure before. So to substantiate and see that this figure is correct, they have to do lots of work. All right? They have to ask for so many documentations, invoices, all right? When they look at receivables, for example, in the statement of financial position, again, that is quite a fresh figure that they've never seen. Go like that until you get what we call current tax, 30 million Kenya shillings. Who computed this figure? It is the auditor. I'm telling you, the auditor will not even take a minute on that figure because they are the ones who computed it. So they are reviewing, review means relooking at. Yeah, you are getting a second chance to relook at your figures. Ladies and gentlemen, for independence to be there, like in countries which are civilized, like in Europe, in the US, if you are an auditor, you are an auditor. You shall never engage in non-audit work. As Aura and the core, what we normally do, because now we are really well established, yeah, we have now great clients, like we have the Kenya Medical Practitioners and Dentist Board being some of our clients. Nowadays, what we have realized, or rather, we are not chasing that big money nowadays, no. What we normally do, whenever you give us non-audit work, so we compare. We normally compare, and I would always want you to write this in your exam. We compare, so we see. Next year, if we do this audit work, 300,000. If I do your tax work, 1 million, so then I'll be able to resign from my audit engagement to take taxation. Yeah, because I don't want to be involved in two activities on the same organization, with the same organization. No, because the moment I start doing so much activities with one organization, number one, especially if this client is very big, remember the self-interest which comes whenever you are receiving lots of your fees from one client. Assuming, ladies and gentlemen, you have 3 clients. And one client here is giving you, say, 55 million. Another client is giving you 15 million. Another one is, for example, so that is 70, is giving you 30 million. Yeah. So in this case here, then your annual fees as an auditor is 100. You are required at the end of the year to go ahead and give us the percentages. So you can see A's revenue, A's fees is accounting for 55% of our revenue as a firm. Whenever you're getting lots of revenue from one client, that client automatically becomes a giant for you. That client will be an intimidating client. Do you know why that client will be intimidating? Because you know, if you lose this client, you're going, in this case here, back to 𝗖𝗍. Remember, for self-interest, ladies and gentlemen, on audit fees, you are not supposed to be receiving a fee from one client which exceeds more than 15% of your total fees. 15% is the threshold. Yeah, we need you to diversify fully so that you have, in this case here, proportionate fees receivable from each client being below 15%. We discovered once we start taking like client one client, or rather 2-3 jobs from one client, then we are not going to meet that 15%. We will get, in this case here, a lot of fees from one client. So nowadays, ladies and gentlemen, what we do, if we get, in this case here, for example, a company that you are auditing, when they want, for example, us to do some other service, what do we do? We bring in another audit firm. There are those audit firms that basically we work together with. Yeah. Initially, what we used to do is to have different engagement teams. Initially, we used to build what we call Chinese walls. Yeah, between our investigating teams. Yeah. So, for example, you have a team for audit and then a team for what here? I mean, even if those teams are different, at the end of the day, you can't run away from self-review. So, ladies and gentlemen, please allow me now to go on to our lesson number 36. I believe like Catherine and others who have been lucky, you've been able to attend all my sessions, right? Yeah, there are those students who have been able to attend all my sessions. Other students, of course, they haven't gotten that opportunity. All in all, we shall overcome. We shall overcome. We shall overcome. I'm only left with 6 sessions because there are 42 in total. There are 42 in total. And remember, I don't teach audit at RCM. I'm only doing these sessions for my audit firm. So my audit firm, those people will be working at 𝗓𝗏. We want them to, I mean, have like a homogeneous way of doing things. So now we make notes for them. We make these videos for them. Grace, unfortunately, no. We shall overcome. We shall be able to discuss about that. We shall be able to discuss about that. We shall be able to discuss about that. We shall overcome. So lecture number 36. So today we are looking at audit of trade receivables and bank balances. Now, ladies and gentlemen, if you go out there, of course, in the statement of financial position, you'll be able to see receivables. Receivables basically are the money customers owe the company. And then now you are working with the 𝗓𝗏, yeah, a firm of certified public accountants, yeah, and then you have sent you out there to go and audit, for example, White Sands Hotel. Yeah, so they have a figure called receivables. Please don't forget, whenever you are auditing, and I always keep on emphasizing this, whenever you are auditing, yeah, whenever you are auditing, ladies and gentlemen, you must always ensure that you know your goal posts, you know your audit objectives. You know your audit objectives. Yeah. So audit objectives are basically the assertions, the financial statements, assertions. If you do not understand these, then that will automatically be like how a football player will be moving around up and down without, in this case here, scoring any goal. However good you dribbled, however good you are able to pass other players, and of course make the ball look nice, we don't have marks for that. Marks will always be given to those particular players who are able to score. It's about how many goals you score, even if you don't know how to dribble the ball. So long as you just get the ball once, you hit it so strong, it passes through the goals, that is it. So also as an auditor, who is supposed to be a detective, a DCI officer, ladies and gentlemen, you must know that you're going to investigate. So what are we going to investigate outside there? What is the objective of this audit? So I must always remember, if you don't quote assertions, you can never pass any audit paper. So these assertions, remember, they are 𝗖𝗚𝗃𝗃𝗃, like that. Yeah. So the objective here is to ensure that financial statements are accurate, yeah, complete. In this case here, we have a classification. They are classified properly. Yeah, allocation, 𝗖𝗙𝗂𝗵𝗃, 𝗖𝗙𝗂𝗵𝗃. Allocation, we have C cutoff, that they have been able to cut off their figures onto the year that they belong. That if you see sales of 2025 is 30 million, then automatically they have not brought in sales of 2026 to this sale. So there is a cutoff between 2025 and 2026 like that. Yeah, 𝗖𝗙𝗂𝗵𝗃. So we have a cutoff. Let me just repeat here, 𝗖𝗙𝗂𝗵𝗃. Yeah, so we have in this case here occurrence, that whatever you are seeing on the financial statements occurred. Yeah, V for valuation. V for valuation. We have, ladies and gentlemen, E for exist. That whatever you are seeing on the financial statements existed. Exist, I mean, existence. And then we have in this case here what we call R, rights and obligations. Rights and obligations. Rights and obligations. Rights and obligations, like that. That whatever you are seeing on the financial statements is owed. Yeah, it is the company that owns it. They have the right, if it's receivables, to collect this money. So the moment you understand that these are the goalposts, these are our objectives as auditors, to go through each of these and you quote them, then you can never go wrong in terms of answering your questions. So we have here audit of trade receivables. So then what are you asking yourself? What are we checking? The assertions. Does the money really exist? When you see that receivable in the financial statements, is that money existing? We have seen many situations where they tell us that our receivables are 30 million. But when you start asking around through what we call confirmations, you realize that those receivables are not even there. Remember, we have got two types of confirmations. We have positive confirmations and we have negative confirmations. So we have positive and negative confirmations. Two types of confirmations. Yeah, good questions there. So we have here positive confirmations. Yeah, under positive confirmations, we expect that when we write letters to our receivables, let me call them debtors. When we write letters to Mr. A, who owes the company, if he believes that the figure stated in the letter is correct or wrong, we expect a reply. So a reply is expected. Regardless of whether the amount on the letter is correct or not, or otherwise. So in the positive confirmations, we expect them to write back to us. And then we have negative confirmations. Negative confirmations. If they agree, no reply. Yeah, so on a negative confirmation, we are throwing a letter to them that Dr. Aura, you owe RCM College 10 million. So if Dr. Aura in this case, he agrees with this figure, he does not reply. He doesn't reply. It's called negative confirmation. It's called negative confirmation. So ladies and gentlemen, are you able to understand the difference between the two? Are you able to understand the difference between the two? Mm-hmm. Yeah, so that is how simple you put it. Yeah, so when we are doing these confirmations, remember negative, first of all, has got so many disadvantages, because at times you may send a letter and it doesn't get to this receivable account. So if it doesn't get to the receivable account and you are at the office thinking that that person never replied because he agrees with the figure. I mean, that is why nowadays, especially for Aura and Co, all our confirmations are positive confirmations, all of them. Yeah, all of them. Whether you are agreeing with the figure or not, just write back to us. Yes, I agree, I owe 10. No, I don't agree, but I owe this much. We expect all of them to respond. So under Positive confirmations, we expect a response to be able to confirm that for sure this amount, in this case here, exists. Now, so they're asking a difference between occurrence and existence. Remember, occurrence is for the income statement. Occurrence is for the income statement. Yeah, that for example, that sale occurred. How do I test it? To test occurrence is very, very easy. I can check the invoices. I can check the goods received notes. So this transaction occurred. Existence is for the statement of financial position. That this motor vehicle that they are claiming to be on their financial statements exists. I'll be able to go and observe this is a tangible asset. Yeah. So can we really collect this money? Yeah, valuation. So we need to do evaluation here. Because at times they tell us, fine, it exists. The customers are even able to confirm, yes, we owe us. But some of those customers are bankrupt. So if they're bankrupt, you can't collect. So the value given there is not correct. Did the company record all the customers who owe it money? Because at times, remember, depending on where they are taking these financial statements, they may not, like have a list of all the customers. Yeah, there could be some customers they want to play around 𝗞𝗡𝗘𝗀𝗀𝗃 with, so they can get to steal even that money, so they omit them. So as an auditor, as a detective, I would want to know whether all the customers that owe the company are in the general ledger. The figure in the general ledger there, is that figure really complete? Is it the company's money? You know, at times, ladies and gentlemen, we could be having receivables, 20 million, 30 million, but at some point we became broke. When we became broke, what did we do? We did what we call debt factoring. Have you guys ever heard of debt factoring? Is there anybody who has ever heard about debt factoring? Debt factoring. Debt factoring is where you sell your receivables. Debt factoring. Debt factoring. You sell your receivables, and then you receive some fees. So for example, your receivables are like 30 million. Yeah, 30 million. So you get a factor, we call them debt factors. Like banks are very good at this. You get a factor, and then you say, these are the students who are owing us, say 20 or 30 million. But because we so much need this money today, just give us 10 million, and then now we are giving this debt book to you. Debt book to you 100%. So in this case, ladies and gentlemen, fine, we shall be having this money in our financial statements as receivables. But see, we have given the right to collect this money to a third party. All right, we have given this money to a third party. Actually, we should have removed this figure that we have given to a factor from the receivables in the statement of financial position. So anytime you are asked to do any, ladies and gentlemen, any audit of receivables, this is the language I expect to be seeing from you. You must always have the objective, the assertion, and then of course you tell us what you're going to do. So in this case here, the audit steps, step number 1, look at payments made after year end. If a customer paid, it means the debt was real. It existed. Please listen, ladies and gentlemen, and listen to me very, very well. You see, we have done financial report for the whole year. So this is the financial report ending on 31st December 2025. Yeah, the report ends like that. So we have receivables at this date. Yeah, those receivables in this case here, one could be owing 30 million, another one 20 million, another one maybe 45 million. So then as an auditor, we are given these books here to audit them in January 2026. That's when we've been given the books to audit. And then, for example, one of these customers pays in January 2026. That becomes a very, very good ground to believe that even the other figures now exist. They are truthful. They are truthful. So in this case here, the first thing I'll do, because I'll be given books to audit, after year end is to look at payments, receivable payments made after year end. If a customer paid, say in January, it means the debt was real. And of course, I can now make an assumption that even the other debtors are correctly stated. Remember, ours is all about sampling. We are sampling. Then, of course, we have to do what we call confirmations. Yeah, that's a very good audit step. Confirmations, positive confirmations to test this existence as well. Yeah, then look at another one. Now here, remember, we are checking things. We are doing inspections. Again, remember the audit procedures. The audit procedures that you must always remember, ladies and gentlemen, audit procedures, the substantive audit procedures, the substantive audit procedures. In this case here, these are the RAEOU, like that. Yeah, so RAEOU, so we have analytical procedures. Yeah, so here you have to analyze a lot. Like at Aura and the company and analytical procedures, what do we know? Because analytical means comparisons. Take the receivables of 2025. Compare this with the receivables of last year. See the growth. Assuming you are also auditing other hotels, of course, without telling the other gentleman, telling the other clients because not allowed, you can also, in this case here, do what we call benchmark. Receivables of, yeah, thank you so much, Catherine. Receivables of White Sands, 20 million. Receivables of, for example, Sarova Stanley here, 100 million. I mean, I can see that difference does not make sense. So I'm doing analysis, I'm doing ratios. We have what we call receivable days, all right? That's an audit procedure, all right? And then we have inquiries. Under inquiries, ladies and gentlemen, of course, I have to talk to the management. I'll tell the management, you are telling me that these receivables are this much, especially the bigger balances. The bigger balances always put the management to task. The management should be able to do representations. Letter of representations. You tell them, you are saying client A and A is owing you 30 million. Yeah, so please do a letter confirming that. Yeah, and then of course, in this case here, that particular client here, we have to do a positive confirmation circularization. We must circulate letters to them. They also talk to us as auditors. Of course, we must get permission from the client. Then inspection, you must be able to know the documents. Like documents in this case here, which documents do you expect from receivables? Of course, in this case here, these receivables, we must have invoiced them. So as an auditor, I would want to see the invoices. They must have done deliveries. So I expect the delivery notes. All right? Or rather, we must have delivered the goods to them. So we have in this case the goods delivery notes like that. Yeah. Observation, ladies and gentlemen, observation, of course, this is where you look at the processes. Yeah, and see how these processes in this case here work. All right. So for example, whenever goods are being dispatched, if I'm an auditor, I would want to sit somewhere and observe the entire process. What documentations are being, before we release these goods, is there a procedure that is being followed? Yeah, recalculation. For example, when they tell me that the doubtful debts, the bad debts, worth 5 million, I have to recalculate. I must recalculate. So whenever you are answering these questions, there are two sets of things you're supposed to remember. You're supposed to remember the assertions vis-a-vis the substantive tests. Like when you hear check customer invoices and delivery notes. So you know here we are talking about what here inspections to see if the customer really bought the goods. So to show that these receivables exist, check the list of old debts. The very old debts, chances are the aged receivables, these will never be paid. Yeah, once you start seeing, like, normally most organizations will give up to 60 days. Yeah, for payments to be done. If you get an organization going up to 90 days, that's a very good organization. It's a very stable organization. But most of them, it's 30 to 60 days. The moment you start seeing receivables of 3, 4, 5 years, you must be doubting. They must be able to give us doubtful allowances. Otherwise, in this case, the valuation of those receivables is fake. To make sure they are not saying that they will get money, they won't. So here, basically, we are testing valuation. Match the customer records to the main accounts like the general ledger. Match them. So the customer ledgers, we have Mr. A account, those ledgers, close them, see how they've been closed, and match those figures to the general ledger to see whether all those ledgers, the sub-ledgers, where the sub-ledgers, all of them are really included in the general ledger to make sure no customers were left out. We are checking what we call completeness. I'm almost finishing. Ask if the company sold any debts to others. And if they have sold the debts to others, we call that factoring. And if they do that, it means that now they don't have the right to collect those cash flows from those customers. They've sold their birthright to make sure that the money is still theirs. So that is the end of receivables. I don't know whether there is anybody who has a question. Is there anybody who could be having a question? Or are we okay with that? For me, it is to give you general audit procedures and assertions. And then, of course, you'll know how to write this in your exams. I'm 100% sure that you'll be able to know how to write this in your exams. Because if you look at all your exams nowadays, it's not about cramming. It's about understanding. And then you should be able to reproduce those points in your own beautiful way. So are we okay, ladies and gentlemen, up to there? For me to move forward, I need to know whether we are walking this journey together. All right. Thank you so much, Grace. Great. Thank you so much. So then we have, of course, the moment you get used to this, like the advanced level, there is a way they twist these questions, and I'll be able to show you. I just want to finish this up to lesson number 42, and then we start looking at our past papers, right? So we have here audit of cash and a bank, money in the bank and the petty cash. So you see, if it's petty cash, I'm able to know how will I be able to test existence. For example, petty cash, I would want to see how they count their monies. I'll be able to see whether there is safe custody. Yeah. So what are we checking? Assertions, I'm a detective here. So I'm doubting these people. So when I go there, in terms of cash, cash is quite a sensitive, risky asset. So what am I going to check there? Can somebody in this case, of course, you are seeing them there. So what I'll be checking, of course, I'll be doubting whether this money exists. I will be doubting whether this money has been shown correctly. Maybe in the shelves, in the safes, they have 20 million, but they are writing 10 million. So accuracy is a point here. They could be having money even in their safes, which does not belong to them. They don't have a right to them. So what are we checking really, ladies and gentlemen, here? We are checking here, is the cash really there? As an auditor, I'm called upon to be very skeptical, to really doubt what I'm being told. So is the cash really there? Existence. Does the cash belong to the company? They have rights. Is the number shown correct? Is the overdraft shown as a loan, not as cash? Presentation, classification. And by the way, this presentation and classification is normally an audit procedure for everything. This is normally a free mark presentation and a classification. Even these receivables up here, you need to do a procedure to just ensure that there is proper presentation of receivables on the statement of financial position. Don't have receivables being taken as a liability. Receivables shall be put under current assets. And remember, we must have disclosures in the notes about receivables. We'll be able to give us an aging register, etc. So always remember that this particular assertion called presentation and classification is really, really important. So audit steps. Number 1, send a letter to the bank asking for the balance. With the permission of your client, after, of course, you speak to the chief finance officer. Tell them to confirm to you whether by last year in their bank account they had 100 million. Once they confirm to you, and remember, as auditors, we always prefer written evidence. We don't work with verbal evidence. So whenever they tell you we had 100 million, not a problem. Already I have a working paper, call them working paper, because we must always have working papers in an audit file. All right? All right? All right? So then, ladies and gentlemen, once in this case, I've been able to speak to this gentleman or this great lady, they have been able to give me their confirmations in writing, then I'll simply write them an email telling them that now I would want to do confirmations to the bank and ask for permission. So if they decline, then automatically I will know that cash was not existing. That bank balance was wrong. If they accept, I will go ahead and write to the bank. Then the bank will go to confirm to me that, you know what, by end of the year, this is what was really as their bank balance. So in this case, you send a letter to the bank asking for the balance to confirm that the bank account exists and has the balance claimed. So existence, we're also checking the accuracy. Look at bank statements at the year end to match with the company's records. So bank statement shows 100 million. How about the bank balance in the financial report? Check the company's bank reconciliations to see if differences are explained and correct. So to see if differences are explained and are they correct. So they are checking in this case here accuracy. Yeah. Whenever you have in this case, remember like then represented checks, etc., we'll be able to see those reconciling items, see whether they are properly explained and whether they are correctly captured. Check who owns the account. They may tell you that this account belongs to them, but it's a lie. Outside here as auditors, people would want to play the 𝗞𝗡𝗘𝗍𝗫 games to confuse us, but we are not that easily confusable. Check who owns the account to make sure it belongs to the company. Yeah, do they have a right to this account? Make sure overdrafts are shown as liabilities. They're not netted off. You know, at times people go and tell you that this overdraft was 1 million Kenya shillings, and because the cash at bank is, say, 30 million, let's now write cash at bank is 29 million. That is wrong classification. That is wrong in this case here classification. We need a class called bank overdraft. So they don't fake cash here classification. Count petty cash. If it exists, you have to count it on a sample basis to make sure the money is really there. It exists. All right. And then, of course, I expect the students who are going through this training to go through this question. It is now having everything that I've been able to teach you. And if that happens, then we shall be able to finish these sessions today in the afternoon. I'll be able to do like 2 or 3 of them so that we can get to proper revision. Otherwise, it has been a pleasure hosting you, beautiful students. Have a lovely day. Thank you and bye.